What does it mean to be underbanked/unbanked? Meet Johnny and Chris. They are among the 22% of American households that are financially underserved. But what does financially underserved mean? This condition is often placed on a spectrum from underbanked to unbanked, with unbanked being the most underserved. Chris is unbanked. He does not have a checking, savings, or any other account with a bank. Johnny is underbanked. He has a checking account, but he also uses alternative financial services for financial transactions that traditional banks conduct. Alternative financial service products include money orders, check cashing services, pawn shop loans, and payday loans. There are several reasons why people are financially underserved. Chris is unbanked because he lives in a banking desert, which means there are no brick or mortar banks within a reasonable distance. Banks won't open branches in Chris's area because his rural town has limited potential for profit. Banking deserts also tend to disproportionately affect communities of color. This has roots in redlining, a discriminatory practice that puts services out of reach for residents of certain areas based on race or ethnicity. Although redlining is currently illegal, its effects persist. Johnny is underbanked because he had issues managing his money in the past. He had a checking account, savings account, and credit cards with a traditional bank, but he had trouble meeting the minimum balance requirement and maxed out his credit cards. Because Johnny and Chris are financially underserved, they are forced to use alternative financial products, which are extremely costly. They each spend about $2,412 a year on interests and fees. The fees from check cashing alone cost them about $1,000 a year. People who use traditional checking accounts and other bank products tend to only pay about $100 a year in fees. Being financially underserved produces a lot of other challenges, as Johnny and Chris don't have access to credit cards or lower interest rates. Since Chris does not have a credit card, he can't rent a car. And since he doesn't have credit, he can't mortgage a house. Chris relies heavily on cash, which makes it difficult to pay bills. Johnny and Chris also aren't able to make interest on their savings, which limits their long-term ability to build wealth. Like a lot of financially underserved individuals, Johnny and Chris are low income. They both have household incomes of under $40,000 a year. Income is the strongest predictor of being unbanked. For households with annual incomes of less than $40,000, 14% are unbanked. For households with annual incomes of $40,000 or more, only 1% are unbanked. Financially underserved individuals are also more likely to be less educated, a person of color, or live in the southern states. The U.S. Department of Treasury established the Community Development Financial Institutions Fund to increase access to banking services for underserved communities. Other organizations and financial institutions have also made it their mission to increase access to banking services for those who are financially underserved. Some are specifically working on initiatives to build trust and confidence in banks, given that is a large barrier for some people. With the help of these organizations and with the rise of fintech products and other mobile banking products, we are seeing the rates of unbanked and underbanked individuals decreasing.